Good morning, folks. I'm happy to present the 20th edition of the weekly wrap. I hope it's been useful for all of you. And today I'm going to speak about some warnings on what's happening in the crypto world in India, and then an interview with an AMC head who's got some interesting views on how earnings are panning out in India. What are retail investors been up to? What are the DIY investors up to? So let's take a quick look at that. Then an update on what's happening with the Mag 7 stocks in the US, and something about the state of the economy from the recent report from the Reserve Bank of India. Okay, so let's dive down. We start with what's happening in crypto. I'm not going to be speaking about how Bitcoin price has been shooting up and tracing new highs, but the perils that are facing investors in India as far as crypto is concerned. So this headline says crypto in limbo. The cryptocurrency exchange CoinDCX has suffered a cyber attack in which $44 million was reportedly stolen from its internal accounts by hackers. This is concerning, and this is just after what happened with WazirX. Last year, WazirX lost $234 million in a cyber heist. So investors, without being aware of the risks, could very easily lose their money in these cyber attacks, which are getting more and more sophisticated, and the frequency are also going up. So please be aware of that. So the regulation as far as crypto is concerned in India is still not clear. Taxation wise it is clear, but regulation is not there. Even SEBI has not said much about it, and we know that cryptocurrency don't have fundamental backing. There are some cryptocurrencies that have backing by way of some reserves like stable coins, but all these have to be put out properly in a policy, and we are hoping that the Indian regulators will do something on this quickly. Okay, and I'm really hoping that people don't lose money in these kind of unwarranted frauds. Okay, so here we have an interview with the chief of DSP Mutual Fund, that is Kalpen Parekh, and he was asked, amongst many other questions, on where his expectations are for the coming earning seasons, and then what does he think on valuations. Okay, and he says, as we head into the upcoming earnings season, we believe the easy phase of earnings and growth is behind us. In the post-COVID period, a powerful combination of robust revenue growth and margin expansion fueled strong profit growth. Okay? Much of this margin expansion, however, was driven by aggressive cost rationalization and operational efficiency levers that may have now run their course. With margins nearing peak levels, the scope for further expansion looks limited as far as margins are concerned. So if earnings have to go up further, it has to be driven by demand and top line expansion. And that is one thing that is falling short. As Kalpen points out, this quarter it has only been a 4% top line growth as it stands for the last year. Not the quarter, for the last financial year, it's only been a 4% top line growth. So till demand picks up, I think it's going to be a little tough for earnings to move up rapidly like the last few years. Okay, and a question to him is, are the valuations euphoric? He says, when markets turn euphoric and capital floods in, prices often run ahead of fundamental. That is a phase we are in, where even minor earnings disappointments trigger sharp volatility. Still, liquidity keeps flowing. Every 5 to 10% dip attracts fresh money. Okay, and a lot of funds are holding significant amounts in cash. The balanced advantage funds are holding a large amount in debt. So it does sort of show that the professional fund managers are cautious about deploying money at high valuations. And data does show that when one invests at these kind of trailing price earning multiples, the future earnings are not very rosy. Okay? So one has to keep this in mind when making any such investments in equity. Okay. So he says returns that once came in a year may now take 18 months or more. So patience and adjusted expectations are important. Let's take note of that. The past 5 years delivered unusually high returns. So naturally, future periods will have lower rates of return. Okay. So let's keep this in mind, and then what retail investors are up to. Okay. So data here shows that a Mint analysis of 1,335 BSE listed firms that have disclosed their shareholding details for the June quarter showed that retail shareholding rose in more than 44% of these companies, at 595 companies. Of these, 38 stocks saw a simultaneous drop in foreign portfolio investors and mutual fund holdings. So what they're saying is that while mutual funds and foreign institutional investors pulled out, retail investors went in. And this is very typical. Professional investors know exactly when to get out of a stock or a business when they see valuations high or the business growth not to their satisfaction. But given the past growth, retail investors not having sufficient knowledge move into these stocks, giving the professional investors an exit. It also shows that retail investors are always the last to pile in and hence take the highest risk. Much of this is also playing out in the US. In the US too, professional investors, that the institutional investors and hedge funds, have been selling out while retail investors have been coming in and supporting the market. So it's not only in the US, it's in India and possibly other markets that the retail investors have been coming in. Some interesting data as far as India is concerned shows that these trading apps being available on mobile phones is a huge motivator to do-it-yourself investors and retail investors to participate in this manner without too much thought. Okay. In 2019, hardly 5% of these trades were from mobile phones. Today, almost 25% of trades are from mobile phones. So one can sort of sense the kind of impulsiveness that drives these trades. Okay. What's happening to the Mag 7 stocks? Okay. So the Mag 7 stocks, I mean, the term was coined in 2023 by a banker in the US. And these are basically a derivative of what we called as FANG stocks earlier. And then they became the Magnificent Seven, because more than 1/3 of the S&P 500 capitalization was accounted for just by these 7 stocks. And even today, almost 35% of the S&P 500 capitalization is commanded only by these 7 stocks. But while these 7 stocks would almost move in lockstep the last couple of years, it seems to be that there are some trends of divergence. Okay. And what is causing the divergence? The report here says the usage of artificial intelligence by these companies is what is determining the future and driving the divergence. So you have companies like NVIDIA, Microsoft, and Alphabet. NVIDIA, Microsoft, and Meta moving ahead, while you have Tesla falling back and Apple falling back and Google sort of not doing as well as the other 3. And the report says that it's mostly how these companies are using artificial intelligence. Apple sort of lost out on this race when their artificial intelligence product did not really catch the fancy of buyers, and it did not match up to expectations. Whereas Alphabet is facing a lot of antitrust laws in the Europe and could face large penalties. But NVIDIA has moving up sharply, as we all know, with greater and greater demand for their chips. And with some of these sanctions on NVIDIA's chip exports to China being lifted, you're seeing that trade opening up too for NVIDIA. So I think as we go forward, it is how they use technology that is going to matter a lot. I think we move on to what is happening with the Indian economy. Okay, so the Reserve Bank of India periodically comes out with a state of the economy report, and they did so for the Q1 also. And happy to say that the RBI is perfectly happy with the stability and resilience of the Indian economy, given all that is happening in the rest of the world, geopolitics, tariffs, and whatnot. Okay, so specifically, it says the India's domestic economy held steady in June and July, showing resilience amid global macroeconomic uncertainty driven by geopolitical tensions and trade related risks. Okay, the improved prospects for kharif or monsoon crops, steady momentum in services sector, and modest industrial growth all have gone to support economic activity in India. Okay, so while we know that the monsoons are going well, and we think that the output would be good, the services sector has been doing very well. The HSBC PMI for services has moved up sharply to 60.4 in June from 58.8 in May. This shows the high level of services activity in the country. And this has also been aided by unusually high export orders in the services sector. Okay, manufacturing PMI is doing okay, inflation is doing all right. So the RBI is quite confident that we meet the GDP growth rate of 6.5% in 2025-26, albeit it is lower than the 6.7 that was originally estimated. But having gone through all the tariff and geopolitical risks that have come up, RBI moved it down to 6.5%, and I think that the economy is in track to reach 6.5% growth this year. Okay, so while retail inflation has been below the 6% marks in September, okay, and even the consumer price index is at a low of 3.5, the lowest in many months, many years. Some data has been showing that core inflation is going up again. So core inflation is the rate of inflation without food and fuel, which add to the volatility of the inflation index. So if you strip out what they call noise of frequent changes and see what's happening to the rest of the product basket, we see that core inflation is creeping up. And eventually this creep up would result in the headline inflation also. So the lower CPI was driving a lot of analysts to say that we could see more interest rate cut from the Reserve Bank of India. But if you see core inflation moving up, and if this trend continues, the probability of such a cut naturally comes down. So let's be aware of that. What's happening with some of the DIY investors? So they, apart from equity, a lot of action has been taking place in the bond side also, because there are a number of online bond platforms where retail investors can very easily and buy bonds for themselves. All right. But what has happened now is the bubble is bursting. Okay. So there was a large default by a company called TrueCap. Okay. So the TrueCap Finance defaulted on interest and principals on its 150 crore NCD issue on 16th July. So all those who had bought these bonds through the online platforms are now losing money. Retail investors get attracted by the high rates of interest offered by these bonds, and without understanding the risk underlying these bonds, they go ahead and buy it. And this is what can happen. I mean, I don't think TrueCap is going to be just one of a kind. There could be many such companies that would default, given that they're in very risky lines of business, and the non-professional investor cannot make this out unless he does a deep dive into the balance sheet and P&L and tries to figure out how is it that these companies can pay a high rate of interest. So my ask of you is, one, do not get carried away by high rates of return offered by investments without understanding fully the risk involved. Okay, so I end my weekly wrap with this. Have a good weekend. Good day.